Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, it's mid-June and we just got a couple of inflation reports. Sort of a good time to take a step back and look at where inflation is, maybe where the job market is, so those two components of the Fed's dual mandate, and check in on, what the market's thinking in terms of Fed cuts later in the year. Of course, Fed cuts are important. Market rates relate to that. If rates start to come down, borrowers are happy, and actually bondholders experience price appreciation when that happens. And so, long story short, everybody's been waiting for Fed cuts, and it's been a while. So let's jump into the data and a little bit the implications, I guess. So let's start with the idea that, when we look at recent data and intentionally kind of looking at the 4 months through the end of May, the CPI and PPI levels were basically at or below the Fed's 2% target. So meaning if you take those numbers, annualize them, they're just really, it's sort of a good block of time where things have remained in the neighborhood that the Fed wants to see. And so everybody's been watching for June. Obviously, people are worried about tariffs. And I would say of the four metrics we're going to talk about, three of them were in a good spot. One of them is just a little bit firm. So let's get into it. So when it comes to June's Consumer Price Index, or CPI, the headline, that was the firm one. It was up 0.3%. And remember that the monthly equivalent of the Fed's 2% target is 0.17%. So just a little bit firm and yet in line with what the consensus forecast was for June. Core CPI, while it had a forecast of 0.3%, it was a little more muted. It was actually at 0.2%. So think of it as, reasonably close to that Fed's monthly equivalent of the 2% target. So those numbers, pretty good, maybe just a smidge firm. When we look at the producer price index, which is viewed as sort of an input, it's sort of earlier in the process, essentially those levels, both the headline and the core, were unchanged in June. And so PPI, even when we extend to look at the the full year-to-date level on 2025, the headline PPI annualized is actually up only 1.4% through the first half of the year, and the core PPI 2.1%, which I think is an acceptable level compared to the Fed's 2% target. So, the punchline here is while people are worried about tariffs, and we've seen just a little firming in that one CPI headline number, basically overall, we're not seeing inflation sort of heat back up yet. And so that's a positive. And that is data that goes into the Fed's consideration as to whether to cut rates, because they have, their Fed funds rate up high to kind of slow things down a little bit and rein in inflation. Now, as it relates to slowing things down, what's been super interesting is that the job market generally, obviously this is in the wake of the reopening from the pandemic, has remained pretty darn resilient. And so, it's almost like what folks are looking for are cracks. And while the data generally has been pretty good, we've seen a couple cracks. And so let's get into that. So I guess to start, the good numbers include an unemployment level at 4.1%. That's a very good number. I think for before the pandemic, the decade through the end of 2019, the average was 6.2%. So 4.1 is a good number. Now, there are some subtleties to this. So for example, about 130,000 people left the workforce in June. So think of it as the number in the numerator going down a little bit because of these people giving up, basically looking for work. And so that has sort of an effect of making unemployment look lower when really it's just some of the folks are stepping out of sort of the population being tested. But still, I would just say overall the number 4.1 is pretty good. And so one data point that has sort of softened compared to certainly a couple of years ago is the JOLTS quits rate. The idea is that people are more willing to quit their job when they feel confident. So the quits rate basically has fallen to just over 2%, 2.1%. and it peaked at about 3% back in March of 2022. So that's one modest thing. The second thing I'll mention is basically job growth. So non-farm payrolls in June, 147,000. Not a bad number, right? Positive, but the 10 years ended December 2019, so pre-pandemic normal, if you will, was averaged about 183,000. So just a little softer than what we've seen in the past for sort of normal levels. And so these are the kinds of things that the Fed's watching for sure. And, what it comes down to as a result is the idea that, hey, if we're seeing inflation cool and maybe people are potentially calming down about the effect of tariffs, both because of negotiation and maybe, companies are kind of absorbing it, then we might have an issue on the earnings side, like profit side. But between that and maybe some cracks in the job market, that could be the catalyst to cause the Fed to take some action. And so right now the market is pricing in, the Fed funds futures are pricing in 2 cuts, quarter point cuts, one in September and one in December. And that pretty much aligns with what we've been discussing, both in our original outlook for 2025 and our update sort of in the middle of the year. We think the Fed's going to cut 1 or 2 times later this year. And of course, as I said at the beginning, that's a positive in terms of making borrowing rates a little bit lower, as well as for bond holders. If market rates follow suit, then there's a slight price appreciation in bonds, just the math of it. So anyway, hey, listen, that's what we wanted to cover in this episode. We really appreciate you taking time to be with us, and we'll look forward to coming back to you next week. Thank you.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.